How's everyone doing?
Good.
Good. All right. As an intro, again, I'm Dan Rosen. I'm on the derivatives team at Luxor. My background is in options trading and market making, so I did that for about 12 years prior to making my way over to Luxor last year to help build out our derivatives marketplace. So want to kind of cover a little bit of background before we dive into specifically derivatives on Hashrate. And so want to cover kind of what commodity markets look like, why they developed, what they look like today, and then kind of give you a pretty good or compelling reason for why we think Hashrate is a commodity, why it looks a lot like a commodity, and why we created these derivatives as well. Oh, one too many there. So commodity markets have been around for a long time, right? So I'd say probably in its current form, commodity markets or exchanges developed right around the 1850s. Chicago is kind of well-known marketplace for derivatives. Everything from grain is kind of where it started in the Midwest to corn, soybeans, everything else that you know today, gold, silver, coffee, all sorts of other agricultural products. And back then, people used to meet in person to exchange the actual commodities. So the farmer would bring their wheat to market and get paid by a dealer for that commodity. There was a big problem with this, is that the farmer was at the whim of the market and what the dealer was willing to pay. And so they would bring their wheat to market, and they would have no idea until they got there what the dealer was going to pay them for their wheat. And so these marketplaces or exchanges developed, and the contracts became standardized. It was a way for farmers to get certainty as to what they would get paid in the future for their commodities, for their grain or their corn or their soybeans. And it was a way for the risks for both sides of the transaction, for the farmers and for the dealers, to mitigate their risks. So they knew ahead of time, 3 months, 6 months ahead of time, exactly what they would be paying or getting paid for that commodity. And that way, for the dealer's perspective, they could enter then into their own contracts at the same time. Hedging today is obviously much more sophisticated than it was 150 plus years ago. And you've got everything from airlines that procure jet fuel from producers of jet fuel like Chevron, ExxonMobil, BP, et cetera. And to use another example, Kellogg buying their commodities for cereal and other products from farmers. But they do that via exchanges now. And so rather than dealing directly with each other, there are exchanges that deal or are the intermediaries between these two and have standardized contracts and have ways to ensure that both products or both sides of the party deliver on their promises. And there are consequences if you don't. So kind of some of the main commodities exchanges today are exchanges like CME Group, ICE, London Metals Exchange, NYMEX, et cetera. There's a variety of these commodity markets, and all of them kind of specialize in their own types of commodities. So kind of took this definition of a commodity straight from Wikipedia, but I think it's pretty darn accurate. So a commodity is an economic good, usually a resource that specifically has full or substantial fungibility. That is, the market treats the instances of the good as equivalent or nearly so with no regard to who produced them. And to me, that sounds a lot like Hashrate. So the market doesn't care whether miner A or miner B created or produced this Hashrate. They don't care whether 100 terahash comes from miner A or miner B. And there are about 6 million ASICs hashing away on the network today. And so that sounds, I know it's a pretty crazy number, that sounds pretty much exactly the definition of a commodity per, well, as big of an authority as Wikipedia is. So I think this leads into what is hash price and why is hash price important. So the hash price, it really is, it's kind of a term that was coined several years ago, and it quantifies exactly how much a miner on the Bitcoin network for a specific amount of hash rate expects to earn per day. Most miners sell their hash rate to pools. And so that number is determined by the pool, what the pool is willing to pay that miner for that hash rate. So we quantify our hash price index at Luxor based on 1 petahash. And for a point of reference, 1 petahash is about 10 of your kind of mid-gen or somewhat newer machines. So if you're running it's like an S19J Pro, for example, and you've got 10 of those, that's right around 1 petahash per day of hash rate that you're generating. We talk about terahash, petahash, exahash. Terahash is 1 trillion hashes per second. Exahash is 1,000 times 1,000 times 1 trillion. So right now, the Bitcoin network has right around 580 exahash of hash rate on the Bitcoin network, which is pretty incredible. In terms of what Hashprice is made up of, so Hashprice really is made up of 3 main components. The block subsidy, which currently 6.25, which post-halving party will be 3.125, is that block subsidy, which we know the schedule of or is fixed. Transaction fees, which are variable over time and variable from block to block. And then you have network difficulty as well. Luxor uses, for transaction fees, we use a 144 block rolling average of transaction fees. And so that usually is about a day of transaction fees. If you do 6 blocks per hour at 10 minutes a block times 24 hours, you get that 144 blocks number. So you can denominate that in Bitcoin. Hashprice can be denominated in Bitcoin, which is the actual Bitcoin that a mining pool would pay you for your hash rate. Or you can denominate it in USD terms. And that would just be the conversion using Bitcoin price in USD terms times the Bitcoin price, or the Bitcoin denominated hash price. So right now, to give you like a point of reference, if you're hashing 1 petahash per second per day on the Bitcoin network, from an FPPS pool, you're expecting to earn somewhere right around 0.00165 Bitcoin per day that you contribute 1 petahash. That equals right around $110 per day of Bitcoin. And this chart on the right, if you guys can see that there, kind of gives you over the last roughly year, this goes October 22 to October 23, of hash price in yellow, and I'll duck down a little bit here. Hash price in yellow is in USD terms, and hash price in orange is in Bitcoin terms, if you can see that. So yeah, you can kind of see this like big spike in the middle here in yellow, and in orange, which was the ordinal spike in May of 2023. When that happened. Obviously, there was a spike in November and December 2023 as well from ordinals. And this is a pretty crazy graph. 2023, what was the network hash rate over the entire year? We started right around 250 exahash on the network and grew to right around 500 exahash. So hash rate on the Bitcoin network in 2023 doubled, which is pretty incredible. All right, so this is from Luxor's Hashrate index site. We have built this index around Hashprice, and we monitor Hashprice every 15 seconds. So we take a price print, where is block subsidy, where is transaction fees on the last 144 blocks, and where is network difficulty at that point in time. We also capture Bitcoin price in USD terms, and we've built this index around it. Kind of on the left there, there's kind of all sorts of stats, so kind of estimated difficulty adjustment for the next adjustment, how many blocks through the epoch are we, what's the average block time been, and then when the halving estimate is. And I'm going to say it's going to be on April 19th. You can't change the meeting now, but maybe we need to unplug to make it go back to the 20th. So yeah, this is kind of similar to what I showed you just a little bit earlier, hash price in 2023. Bitcoin hash price, and actually I'll show you this in just a little bit, but Bitcoin denominated hash price tends to go down pretty steadily over time. And what does that mean? It means that the value that you're receiving in Bitcoin from a mining pool for 1 petahash continues to decrease, and that's because the value of a hash continues to go down over time. And so as these new gen machines, Bitcoin mining machines, are created, the S21 is anywhere, I think, David, correct me if I'm wrong, 185 terahash to 200 terahash machines, instead of the S19J Pro, which is 100, and then I don't even know where the S9s were, 40 terahash or somewhere around there. 14. Okay, 14, sorry. Even less, so the value of that hash rate has kind of continued to decline in Bitcoin terms over time. In USD terms, it has stayed a little bit steadier. And this is kind of that exact graph, the Bitcoin denominated hash price over time. So this goes from 2019-ish to present day. Petahash used to be worth 0.04 Bitcoin in 2019, and now it's worth that number I gave you, 0.00165 Bitcoin per petahash. So pretty wild. Yeah, so kind of just wanted to briefly go over kind of the factors that I had mentioned that impact hash price. So transaction fees are one of the biggest ones and most relevant, especially over 2023, when we saw spikes in ordinals, or due to ordinals activity. And pretty wild, like how large the average daily transaction fees were per block. They got up to right around 4.5 Bitcoin per block on top of the block subsidy in May of 2023, and then we saw similar activity in November, December. So this is definitely something that helps miners remain profitable, and obviously that network activity and higher congestion in transaction fees helps miners stay profitable for longer. Similarly, kind of we saw that network hash rate graph in 2023 grow pretty steadily. Same thing as you'd expect for network difficulty. As hash rate grows, so does network difficulty. And so it's become harder and harder and less profitable to mine over time. So from a mining perspective, there's really two things that you need to optimize for. And you can have one or the other, you can have both, but you can't not have either of them. And that's the efficiency of your fleet. So how many joules per terahash are your miners consuming? And then also the efficiency of your fleet, and then sorry, what was I going to say? Not the profitability. Sorry, well, the price of Bitcoin. I totally blanked there. I'll come back to that, I promise.
Electrical cost.
It's electrical cost. Yeah, so it's the efficiency of your fleet or electrical cost. Thank you. So you can have 4 cents per kilowatt hour of electricity costs and be super cheap electricity costs there, and have less efficient machines, or you can have efficient machines and have higher electricity costs. So as I mentioned earlier, we built out this hash price index, and we're taking price prints every 15 seconds over the course of every UTC day. What are the terms of our forwards? And so what our forwards do is gives a derivative to be able to trade based around that hash price index. So what we wanted to do, let me back up. There's 3 main risks as a miner. Number 1 is your electricity costs. Number 2 is your revenue costs, right? Or your revenue, not costs, your revenue. And number 3 is your treasury risk. So the Bitcoin that you're earning and that you're keeping on your balance sheet. And so there's a way to hedge most of your electricity costs as a miner through energy contracts. There's a way to hedge your Bitcoin price if you so desire as a miner. But there really wasn't a great way to hedge your revenue. And Hashprice gives you a way to hedge your revenue. It gives miners a way to lock in a certain revenue for a certain period of time. And so we wanted to provide this service to miners to be able to say, hey, I know that I am profitable at, let's say, $100 hash price. And I want to lock in that hash price for the next 3 months or 6 months. And so this gives miners a way to hedge the revenue side of the equation rather than just the cost side and the balance sheet side of the equation. So our contracts look at hash price from the buyer and seller's perspective. What hash price are they trading? What is the amount of hash rate that they're trading? Starts at 1 petahash, can go all the way up to 100, 1,000. We go up to several exahash in liquidity as well that you can execute. And then dates as well is very important. So do I want to hedge for the next 15 days? Do I want to hedge for the next 30 days, 60 days, 180 days, as far out as we go? So this kind of gives you, this is our front end platform here. We've built this front end to be able to display these contracts on a monthly basis. As you can see, this was actually today's snapshot. So March on the left all the way through August. We go out as far as 6 months. You can see spot price is highlighted in yellow across all of the months there. Right around $111.60 was today's latest print. And you can see where the market is pricing hash price, not only for today in the month of March, but also for April, which includes roughly 20 days pre-halving and 10 days post-halving, but also in May too. So you can see what the market is pricing, or the expectation of hash price is for May, June, July, and August. And so obviously with the block subsidy being halved, the May hash price is expected to be somewhere right around $60 per petahash per day in May. Hopefully that continues to grow as Bitcoin price rallies, but this is where the marketplace is betting that hash price will be. There are market makers on our platform that provide this liquidity, and all the numbers that you see in kind of green and red are bids and asks. So these are people or market makers or market participants that are willing to buy or sell Hashrate for that particular month in that quantity. So somebody's willing to buy 100 petahash in the month of April, for example, for a price of $80.25. And these are all in petahash terms, these quantities in the green and red. So you see right around 850 petahash of liquidity and obvious liquidity in our markets. That was USD denominated hash price. This is Bitcoin denominated hash price. So you can look at it from either perspective. In May, they're looking at hash price in Bitcoin terms being right around 0.0009 Bitcoin per petahash. Overall, we've seen some pretty tremendous growth in the forwards, Luxor's forwards marketplace. So we launched the product officially in beta mode in November of 2023. Started to really gain some traction in Q3 of last year of 2023. And then in January, we executed way above and beyond kind of the sizes that we had executed in quarters past. So I think really starting to see some very obvious traction in this market and really starting to see demand from miners to hedge their revenues. And I think that will continue to be the case as these margins for miners continue to shrink post-halving. So rather than having currently 100 to 150% margins on electricity costs, these miners' margins are going to be 10, 20, 30% max post-halving. And so I think that need for hedging will continue to grow post-halving. In the marketplace, we've got right around 60 market participants that we've onboarded to our markets that are, I wouldn't say all of them are actively trading, but I'd say 25 to 30% are pretty actively trading. We have 7 or 8 pubcos, mining pubcos that are onboarded as well. And the eventual kind of road where this is going, this is all traded OTC right now, but the eventual road is to have kind of an exchange-based product at some point, hopefully this year. So really excited to kind of see where this goes, and excited to be part of kind of this derivatives story to give miners another tool to hedge their revenue on that side of the equation. I think that's mostly all I've got for you. I'm happy to answer as many or as few questions as you'd like. Yeah, go ahead. Either one, go.
What kind of relationship do you have with the miners? You've got like basically top 4, top 8 that really came for Hashrate like that. What does that look like? Do you have direct relationship with them about trading their product as a derivative?
Yeah, exactly. So I think the miners you've started to see really over the last maybe 3 to 6 months start to build out trading desks. And I think this is super important because almost every other commodity market has a trading desk, or any commodity producer has a trading desk. So you look at an agricultural producer like a Cargill or Archer Daniels Midland or Macquarie, all of those have trading desks. All of the gold producers, all of the oil producers all have trading desks because they are experts in the commodity that they produce. And so you've seen over the last 3 or 6 months, these large public mining companies that have realized that they need to start building out trading desks and are starting to bring in that expertise from the TradFi world. And so, yes, we do have kind of direct relationships with those pubcos or those mining companies. We do everything from kind of the guy mining, maybe 10 petahash to all of the pubcos as well. And they trade directly through our desk. We are actually the market operator. So we match buyers and sellers in our marketplace, and we ensure that both sides deliver. That essentially the losing side of the trade delivers to the buyer or to the winner's side of the trade by collecting margin. Yeah.
So thanks for the presentation.
Yeah.
That's really great.
Absolutely.
I love the CME shout out is great.
Yeah.
So it makes sense to me that like the natural seller of the forward would be a miner trying to hedge in USD to cover expenses.
Yep.
So my guess would be like that's probably your largest market is natural sellers of these.
Yeah, absolutely.
miners.
You're spot on.
who's the natural buyer of that contract?
Yep.
Like, who's the other side?
Great question. For the right price, anybody is probably in their right mind to buy Hashrate. But in order to provide an attractive price, we have a couple of market makers onboarded to the platform. So one of them is a kind of energy/hybrid Bitcoin miner. So they're mining themselves, and they have kind of expertise in mining. And then another one is a large, just general crypto institution. Generally, so they're providing kind of the bids and offers that you saw on the sheet. But overall, buying Hashrate is a way to get synthetic exposure to Hashrate without having to physically deploy Hashrate. And it's a way to, rather than going through, and I'm not saying this is necessarily the right way, but people don't necessarily always want to go through the burden of time, effort, and money of deploying physical Hashrate. So we do see frequently buyers that are looking to get synthetically long Hashrate in that way for the right price.
And so does it settle continuously?
Yep. So we have daily settlements. Those price prints take every 15 seconds over a UTC day, and we take the average of all of those 15-second price prints, average them, and get one daily settlement, to which you are mark to market.
So it might be a month-long contract, but it
Yep.
can accrue and deliver daily.
Correct.
To both
Yeah,
parties?
P&L happens on a daily basis.
Oh,
Correct.
That's brilliant.
Yeah.
That's really interesting.
Yeah.
Are they USD or Bitcoin settled?
Good question. Depending on which product you're trading. So Bitcoin hash price is margined and settled in Bitcoin. USD hash price margined and settled in USD.
So follow-up would be,
Yeah.
have you seen any of the big ETFs buy Bitcoin settled?
We have not yet. Yeah. It could potentially, just like mining is, potentially be a way to buy, spot Bitcoin essentially at a discount to, fair value.
That's why I said anybody could be a buyer.
Yeah. We definitely target, there's an onboarding process, so we are definitely a little bit more institutional focused, but there are minimum requirements to onboard. Yeah.
Did you guys develop this hash futures market, or is this something you just tapped into?
Yeah, I think there have been a couple of attempts in the past to build out this kind of marketplace. I know there are a couple DeFi projects that have tried to do this on-chain on the Ethereum blockchain. There have been a couple of attempts to do this in a kind of centralized, similar way to Luxor in the past. I don't think any of them have gained very much traction until I think this. So, yeah.
Why do you think that is? Like, why has Luxor?
I think timing. I think the maturity of the mining industry, in large part. Like I said, a lot of the big mining companies haven't even built out trading desks for this commodity yet, and so I think it's finally starting to become, or that maturity is finally starting to come around for miners to understand that they need to do that. Yeah.
Because nobody's hedged.
No, or at least not very many people are hedged.
They're praying for a number to go up.
Yep, exactly. Yep. And this is a way to lock in that revenue and margin.
Something you would hedge against. It's easy to imagine crops being knocked out by bad weather.
Yeah.
What's average bad news?
Yeah, difficulty. Network hash rate growing. So
Faster than you'd expect.
yeah, exactly. Faster than the market might expect. Correct. And this is kind of where like that expertise in the commodity market really comes into play, because if you are, I don't know, let's use Riot or Marathon or one of the large pubcos, and you know that you're bringing on 6 exahash in the next quarter or 2 quarters or 3 quarters, you have a distinct advantage in knowing that you're bringing on more hash rate. So you might want to hedge ahead of time because the value of your existing fleet will go down. So it's kind of like any agricultural producer or any commodity producer. Hey, I know the crop is going to be really good this year, and so that's going to drive prices down, and so I want to sell it ahead of time.
So there's some like information.
Kind of absolutely. I wouldn't say quite yet, but yeah, I think there will be at some point. Yeah.
How far in advance can you go? Is it the 6 months?
Yeah, good question. Yeah, we go out as far as 6 months right now. Plans to go out as far as 12 months at some point this year as well. That'll be really interesting to see how the market and where they price hash price for 12 months out.
The premiums increase the longer duration the contract is, just like normal options, right? Like the time value of it.
I think the spreads would be wider because there's more uncertainty as to where hash price will be in 6 months or 12 months. the spreads for, say, March or April contracts are pretty tight, although April is a little bit special because of the halving. But March, there's a fair bit of certainty as to where hash price will be because we know we only have 2 difficulty adjustments in the month of March. We have a pretty good idea of where this upcoming one will be, so the market is kind of pricing those in. Yeah?
You might have answered this already, but
Yeah.
is it becoming more attractive to buyers of the product because of transaction fees and it might catch shipping a week up?
Yeah, that's actually a pretty great question. What we've seen historically, at least throughout 2023, is you see these kind of periods of time where transaction fees are muted, and the volatility in transaction fees is really only to the upside, meaning you get the ordinals mints or ordinals craze, and so you've got this period of congestion in the network, and that tends to last. That congestion takes a long time to clear. And so you typically see these transaction fees that spike and stay relatively high for a period of time. I think one of these graphs shows it. So you can kind of see early 2023, the first, I don't know, half to 2/3 of this chart before the spike, transaction fees were really low. And it took a while for the transaction fees to come back to that level, somewhere around 2 months for them to come back to that original level. So, yeah.
I'm curious because you have so much experience just in commodities broadly.
Yeah.
And this market is, I mean, it's like 35, 40 years ago what would be happening, or in commodities, coming out Chicago school, things like that.
Yeah. Yep.
So there's been that much development in the commodities markets, and we're just beginning to apply these things to Hashprice and the Bitcoin ecosystem.
Mm-hmm.
What are you most excited to see next?
Yeah.
Or where do you see the market maturing outside of just becoming bigger?
Great question. Yeah, I mean, like you said, we're not reinventing the wheel here. This all exists in traditional commodity markets. I don't know, where am I looking excited for this to go? I'd say kind of some of the things we're considering working on is transaction fee forwards. So where you can just trade transaction fees would be a pretty sweet complement to trading hash rate, since it's one of the components. Bitcoin-denominated energy contracts would be pretty awesome. That would give miners a way to hedge their energy costs in Bitcoin terms as well. So I'd say those are kind of the 2 things I'm most excited about.
Would you be working
coming.
with energy companies directly?
Yeah, probably. Yeah, for the energy side of things. Yeah, exactly. Or partnering with them. Yeah.
That was my question.
Yeah.
What is your relationship with the energy sector? Because you see a lot of these crossover
Yeah.
energy Bitcoin.
We sorry if I didn't reply. We don't currently have, I'd say, extensive relationships with energy sector or energy producers for the most part. Definitely miners have a lot better relationship with a lot of them than we do at this point. But yeah, I think that'll be a huge part of, exactly. So, yeah.
Any of these Bitcoin-denominated contracts that require Bitcoin settlement, is that all handled on-chain, or do you use
Yeah, so we do use kind of third-party custody provider to hold the margin. We do release, or customers can take back the margin on a daily basis, so we can facilitate that. It's obviously on chain that they're sending us the margin or sending the custodian the margin, and then we're sending it back to them. Yeah.
You're subject to.
Yep. Yeah, to transaction fees as well. Yeah. I think kind of to go along the same lines, that kind of sparked a little thought too. Transaction fee forwards, but block space forwards as well. So if I'm, and you've seen some of this with accelerators and kind of Marathon announcing their I guess custom, or I don't know too much of the details, but so being able to be guaranteed block space at some point in the future. Yeah. Yep. Yeah.
So I was curious, does Luxor do anything with physical delivery? Is that where the firmware comes in?
Good question. Not so much incorporated with firmware, but Luxor runs a mining pool as well. So we've got, I think, somewhere around 3.7% of network hash rate at our mining pool. And so we do actually have, in addition to this non-deliverable forward, which is kind of the synthetic representation of hash rate, we do have a deliverable forward as well. And so what that looks like is miners are able to sell forward their future production of hash rate up to 6 months forward and get paid upfront for that. They're selling it at a discount because they're getting the money up front, so time value of money plus getting those funds and the risk associated with that miner not delivering. But it's all settled through Luxor's pool infrastructure. So these are derivatives contracts settled on Luxor pool. And so, for example, they might receive, I don't know what the number is, 5 Bitcoin for delivering 100 petahash over the next 60 days. And so they get paid that 5 Bitcoin up front. And then over the next 60 days, we deduct 100 petahash worth of hash rate, depending on where Hashprice settles on a daily basis from their pool sub-account. So it's a physically delivered hash rate. Yeah. Sorry, go ahead. Go ahead.
Is curtailment accounted for the hash price like every 15 seconds? Like,
You're saying for the deliverable forward, or
yeah.
so?
I mean, like, yeah, in the future, like let's say
Yep.
like, you might curtail like 4 to 8 hours a day.
Yeah.
What happens during like the 15 seconds or whatever?
Yeah.
intervals that are being curtailed?
So the 15-second price prints are just to get a daily settlement for the index. And so that index is multiplied by the amount of hash rate that they're contracted to, that 100 petahash, to determine how much Bitcoin they have to deliver on that particular day. And so curtailment is taken into account because there's obviously curtailment or potentially operational risks for the miner that they may not be able to deliver that hash rate. So yes, we do have to go through all sorts of credit profiling. We make sure that the hash rate is over collateralized, meaning if you're selling forward 100 petahash to Luxor, then we're going to make sure you have something like 150 petahash on the pool in case you do dip down. Yeah, yeah, yeah.
That's what I was
So,
thinking.
okay, yeah.
Collateralization requirement.
Yeah, we do actually have kind of access to a third-party insurance provider in case that miner does not deliver too.
Cool.
Yeah, yeah.
Do you see with the ETFs live now and the option chains for those being activated probably the next 6 months?
Yeah.
What do those additional products? What can you use those for to make this even more powerful?
Good question.
So
What were you thinking?
So my facility is too small to use this.
Yeah. Okay.
So I had already started to think how I could use the option chain on, say, IBIT
Yep.
to do downside hedging with selling puts.
Yep. Or buying puts and selling calls. Yeah.
And basically constructing synthetically what you've done,
Yep.
but on a much smaller scale.
Yep.
But I would also see things like you could basically make it even more synthetic.
Yeah. 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 Good question. And I do think that's a kind of natural next step. Kind of once you have exchanged futures on hash rate or hash price, that the options is definitely a next step after that. But yeah, definitely as a miner kind of on the smaller side, I would say, yeah, Bitcoin options or ETF options are probably the best way to go to hedge. Yeah. Yeah. Yeah, sorry, I think back there first. Yeah.
Do you think you could do this like with a discrete log contract and like do it all on chain instead of like sending your money to Luxor?
Yeah, instead of having like a centralized, yeah. Yes, I think, like I said, the natural progression is futures, and I think that eliminates a lot of the counterparty risk. I think futures exchanges have shown to be pretty damn resilient over time, and yes, you could do this on chain. I don't think we are equipped to do that anytime soon, though. Yeah. Yep.
I want to do the math again, like 100 terahash machine.
Yeah.
How many machines would you need to have one unit on the exchange?
Yep. So 100 terahash is like an S19J Pro. 10 of those is 1,000 terahash, which is 1 petahash. So 1,000 terahash is 1 petahash, and 1 petahash is kind of all of our denominations.
So someone running a facility with 1,000 machines.
Yep.
At the entry point.
No, 1,000 machines would be about 100 petahash.
Oh, okay.
Yeah. So 10 machines is kind of the minimum contract size that we deal with. Yeah. Exactly. Yeah.
You mentioned that it's like growing quarter over quarter in
Yeah.
volume, right?
Yeah. Yep.
Are you
Exactly.
also seeing like sophistication in terms of like bids and asks tightening?
Tightening. Yeah. Yep. We have 2 main market makers that provide liquidity. We are definitely trying to get a couple more to tighten those spreads and provide larger sizes. Like this graph shows we like one of our largest trades we executed was 1.5 exahash in size in January for the month of February, and yeah, I mean that's obviously the goal, is to try to get as tight and liquid and small spreads as possible in these marketplaces to give miners an option to hedge without very much cost to do so. Yeah, because right now you're right, exactly right. They kind of have to cross that like bid-ask spread in order to hedge, and so as tight as we can get it is better. So for everyone.
Does Luxor just take a margin on every trade?
Yep. Yeah, it would be very much like an exchange, like where we charge a per contract fee. Yep.
Do you want to discuss those fees?
Yeah, happy to. So right now we charge a 2.5% spread fee for every trade. There are volume-based incentives to get that down to 1% if you're trading larger size. So it's essentially like if you let's say pay $100 for a contract, your net executed price would be closer to $102 or $102.50. So, yep. So obviously the goal is to get more volume and to drive that spread fee down. So yeah. Yep. It's a still, I'd say, somewhat nascent marketplace. So yeah.
It's all over the counter, right?
It's all OTC traded, correct? Yeah. Yeah.
I forget if we talked about this. Does Luxor have their own mining operation as well that they're contributing to your pool?
You might know better than I do. We do a lot of R&D.
We have a very
Yeah.
self-mining operation. Very small.
Yeah.
It's primarily the pool, where the derivatives.
Yeah.
Many
Yeah.
other product lines as well.
I don't think we have anything more than like 10 petahash or something like that.
I was just curious
Yeah.
if you guys use your own product.
You're saying derivatives product? We try not to as much as possible because we're the market operators. So like to have integrity in the market, we don't want to be participating or buying or selling to one side or the other. Yeah. Yep. How does the firmware play into it? I'd say mostly entirely separate. Yeah. Yeah. I mean, you could get more hash rate and then you could hedge more, I guess. But yeah, it's mostly separate. Yeah.
The people selling deliverable forwards are using our firmware, then that's like extra bonus for us.
Yeah. I'd say kind of maybe the better integration is kind of, as I mentioned, using the mining pool for settlement for the derivatives contracts, but then also those miners using the deliverable forward to get upfront funds for their future production of hash rate, using kind of our ASIC brokerage desk to purchase more machines. And that's one of the other main services that we offer, is that brokerage for mining machines. Yep. Cool. All right. Thanks for all the questions. Appreciate it.